Hello, everyone, and welcome. If you're a tax professional or a property owner, you know just how crucial it is to get your deductions right. Today, we're diving into one of the most important sections for anyone with property income. That's Section 22 of the new Income Tax Act 2025.
So, do you own a rental property? Or maybe you advise clients who do? Well, mastering the deductions under Section 22 is, frankly, non-negotiable. It can be the difference between a smooth, accurate tax filing and a potential headache from the tax department. So, let's get this right. Here's our game plan for today. We'll start with the legal groundwork. Then we'll jump into the two main deductions, the 30% standard deduction and the interest on any loans. After that, we'll walk through a real-world example, cover some compliance tips and common mistakes, and wrap it all up with the key takeaways.
Okay, first things first. Before we can even think about deducting anything, we need to know what we're deducting from. And the entire calculation kicks off with a figure called the annual value. So what is this annual value? Well, Section 21 defines it for us. The easiest way to think about it is as the property's earning potential, what it could reasonably be rented out for over a year. This number is the absolute foundation for everything that follows.
And here it is, straight from the law itself. Section 22, subsection 1, tells us in no uncertain terms that we compute our final income after we make certain deductions. This very sentence is the legal green light for all the tax-saving provisions we're about to explore. All right, let's get into the first and honestly, the simplest deduction you can claim. This is a flat, no-fuss reduction that's available to pretty much every property owner with a taxable annual value.
The first deduction is beautifully simple. The only number you need to remember is 30%. That's it. Section 22(1)(a) gives you a flat 30% deduction right off the annual value. No questions asked.
Now, the best part about this is that it's completely automatic. It's a statutory allowance that's meant to cover all those little costs of upkeep. You know, repairs, painting, insurance, and so on. You don't need to collect a single bill or prove you spent a rupee. You just calculate 30% of the annual value and you deduct it. Simple as that.
Okay, let's move on to our second major deduction, the interest on borrowed capital. Now, this one's a bit more involved, but this is where you can find some really significant tax savings. The Act is very specific here. It splits the interest deduction into two different buckets. First, you've got the interest you're paying on your loan during the current tax year. And second, and this is the part that often trips people up, there's the interest that was charged before you even got the keys to the property. We call this pre-acquisition or pre-construction interest. And here's where the treatment really differs. Current year interest? That's simple. You can deduct the full amount in the year it's payable. But for that pre-acquisition interest, you can't. The law says you have to take the total amount and spread it out. You claim it in 5 equal annual installments starting from the year you acquire the property. This 5-year rule is absolutely crucial to get right. You know, theory is one thing, but let's see how all of this actually works with some real numbers. Applying these rules to a practical scenario is really the best way to make it all click. So let's walk through a calculation together. Okay, so here are the facts for our case. We've got an annual value of 5 lakh rupees. A loan was taken for construction. For the current tax year, 2026-27, the interest paid out was 1,80,000. And here's the key part. The total interest paid before the construction was completed was 1 lakh rupees. So let's break it down. We start at the top with our annual value of 5 lakh. First things first, we knock off that easy 30% standard deduction, which is 1,50,000. Next, we deduct the current year's interest, which is 1,80,000. And finally, we deal with that pre-construction interest. We take the total of 1 lakh divided by 5, and we deduct this year's installment, which is 20,000. And that brings us to our final taxable income from house property, 1,50,000 rupees. So, knowing the math is great, but it's only half the story. Now we need to talk about the practical side of things, compliance, documentation, and how to avoid the most common mistakes. Here's a quick compliance checklist to keep you on the right track. Number 1, and this is non-negotiable, always have the interest certificate from your bank. That's your proof. Second, make sure your loan was actually taken for acquiring, constructing, or repairing the property. Third, double-check and triple-check your 5-year schedule for that pre-construction interest. And a final tip. Remember, for up to 2 self-occupied properties, the annual value is considered nil, which means that 30% deduction doesn't even come into play. Now let's look at the flip side. What are the common traps that taxpayers and, yes, even professionals sometimes fall into? What are the mistakes that can trigger a notice from the tax department?
Okay, the number one mistake we see by far is someone trying to claim all of their pre-construction interest in the very first year. You just can't do it. Remember, it has to be split over 5 years. Another one is forgetting about certain clawback rules if a property is sold too quickly. And like we just said, trying to apply that 30% deduction when the annual value is already nil is a no-go. Oh, and on a positive note, be careful with your loss carryforwards. The good news is that the new Act's FAQs do confirm that you can carry forward house property losses from the old regime. That's a huge relief for many.
All right, I know we've covered a lot of ground today, so let's just take a moment to boil it all down into a few essential points that you absolutely need to remember. Let's recap. 1. Everything starts with the annual value. 2. You get an automatic 30% standard deduction right off the top. 3. The interest you pay on your loan is deductible. 4. Remember, any interest from before you got the property has to be spread out over 5 years. And 5. Meticulous documentation, especially that loan interest certificate, is absolutely key. And that's a wrap on our deep dive into Section 22. Thank you so much for watching. If you found this explainer helpful, we'd really appreciate it if you'd like, subscribe, and share it with your network. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.